relatively less fragile than many of the other countries that have been mentioned in the report, which are Indonesia, Brazil, South Africa, and Turkey. India actually started tightening its monetary policy ahead of many of these other countries. Brazil, if you remember, actually lowered interest rates before picking them up again. Turkey has had to resort to desperate measures like increasing interest rates by 425 basis points, taking it up to 12% in some cases. So in a sense, India has been through this cycle somewhat earlier in the year. In August, when the Indian rupee fell to 68 against the dollar, that is when the RBI, Reserve Bank of India, the Indian Central Bank, started tightening its interest rates, started initiating a host of measures that stemmed dollar outflows, that looked at reducing volatility in currency markets. Also, at the same time, they took a lot of decisions on the economy, such as things like curtailing the gap in the current account by increasing duties on gold imports, by initiating a whole host of export promotion measures. And these have helped shrink the current account deficit. One of the main sources of worries among foreign investors will be the widening current account gap. And that, to a certain extent, has been mitigated. So, given all of this, it is now, it seems that India stands a better chance than most of the other countries that have been lumped in the Fragile 5 or Fragile 7, if you include Ukraine and some of the other countries that are facing huge volatility. But the one thing that's common among most of these countries, and India can't escape that, is the fact that all these countries have elections coming up sometime during 2014. And that's a political risk that's inescapable. We don't know what holds for India in 2014. The worst case scenario is a fractured mandate, and a fractured mandate translates into delayed reforms and delayed economic decisions, and that spells bad news for the Indian economy. And so therefore, that could worsen the situation that India currently is in. But between now and then, it seems India is on a stronger, safer footing than most of the other emerging market countries. So as we said, one of the primary risks is the political risk. But apart from that, I don't see a huge outflow of capital from India. In fact, I think the currency risks are also overstated in the case of India. We may see a bit of volatility in currency trading, but beyond that, I don't see a great deal happening. I don't see shutouts happening, as some of the economists have mentioned, because remember, the US stock market's also not doing terribly well. S&P 500, Dow Jones Industrial Average have all collapsed in the past week, primarily again because of weak manufacturing numbers. So some of that money has to go out to some other markets. And India at this point of time, I think in terms of valuation, looks pretty attractive. Number two, the US economy also isn't really doing well. The drop in the manufacturing numbers was the steepest in the last 33 years, and that's been spooking investors. So some of that money is bound to come to India. And finally, I think tapering, much is being made out of this tapering spook, so to speak, because they're only reducing purchases by $20 billion. They're still going to pump in $65 billion of cash into the market every month for the next few months in the foreseeable future. Given that, I think some of that money will go into equity markets, will go into commodities. There's another great advantage for India because of tapering. Fewer money will flow into commodity speculation, and that will bring down some commodity prices which form part of India's import baskets, such as, for instance, petroleum and crude. And that is a great blessing in some ways for India.